A bill titled the Woke Endowment Security Tax Act of 2023 was introduced by Arizona Senator Tom Cotton on December 12, 2023. This bill adds to Title 42, Section 4969, a new annual tax against specified educational institutions. This tax is equal to 6% of the fair market value of the assets owned by an educational institution at the end of the previous taxable year. The fair market value of an asset means what the overall market says the asset would be purchased at right now, as opposed to its value when it was purchased or what it would be valued at in the future. An asset is anything owned by an organization that will help produce an end result, hopefully profit, but is not a debt. For instance, cash is an asset just like a computer or tractor is an asset, since they can all be used to buy, make, or perform an action in the name of revenue. Money owed to the organization also counts as an asset, an accounting term known as accounts receivable. This is very important since educational institutions can have a lot of money owed to them that has not been paid yet for classes that have already started or are about to start. This may include student loans as well. However, per the definition of an applicable educational institution, these loans may belong to the federal government's U.S. Department of Education instead of the school itself, not increasing its asset value. If the school does own the loan, however, this can increase the total of their asset value, making this tax even higher in total. This bill specifies an applicable educational institution as one of two categories. The first is any educational institution that has a fair market asset value of $12.2 billion or more. The second is any state-sponsored college, like a community college or a college with the name state or state university in it, that has a fair market asset value of $9 billion or more. The bill does specify that religious institutions of education are not included in this and will not be taxed. This is a very common practice to have religious institutions of all kinds be exempt from taxation, regardless of what kind of institution it is, how immense the revenue and profit is, or what or where the money is used. For more information on what defines an asset and a student, please go to United States Code, Title 42, Section 4968. This bill will apply to all taxable years starting after December 31, 2022. Primary impact. There are not many state educational institutions that reach the $9 billion threshold, let alone $12.2 billion. To give perspective, Yale University, according to data.com, had an endowment, which is money invested into a business to assist its growth and is counted as an asset, of $42.3 billion, alone. This means that already expensive education institutions will get more expensive as the loss in profit to tax expenses will require the difference to be made up elsewhere. This difference will either be higher tuition and other expense fees or a reduction in services or programs offered. Demand for a degree from Yale will decrease, and unless the overall demand for college education also decreased, other universities that were not affected by this new expense will be demanded more. This increase in demand will cause a natural rise in price, therefore making college degrees at lower levels of educational institutions more expensive. Secondary impact. In order for institutions to relieve themselves of some of this new expense, assets may need to be removed, or some other forms of financial activity must take place to reduce asset value. If the removal of assets approach is utilized, students and other members of the institutions will suffer as they no longer have access to those assets. On the other approach, financial trickery can be very dangerous if done improperly, leading to over-execution of liabilities or underutilization of other assets that result in harsh, short-term fluctuations. Tertiary impact. At 6% of total asset value, even the smaller $9 billion would generate $540 million a year from a single educational institution. That is only if the institution meets the minimum threshold. If they have more, they pay more. This is a lot of income for the government that, if it is used correctly, can have great benefit to the growth of the United States. Quaternary impact. If the lower levels of educational institutions, those colleges and schools that were mentioned in the primary impact as having higher demand, will find themselves with much more revenue to grow with, possibly leveling the playing field against larger, more famous and accredited institutions. There may be less supply of degrees or vocational education available depending on the institutions and their style of classrooms, like hybrid virtual classrooms that allow more students to be enrolled in a single class at once. A lower supply could also result in an increase of price, but will also naturally level out if left to its own devices, usually at a higher price than it started at.